Stock market terms for beginners. So I'm going to explain 10 terms extremely simply, just to get the basic understanding of these across. The first big three to know are stock, market cap, and EPS. Okay, so the first one is stock. And when you own stock, you own a part of the corporation, and you own a claim to what the corporation assets are. As a common stockholder, you have the right to receive dividends, as well as if you have enough percentage of stock of the company, you have the right to vote. A preferred stock owner does not have the right to vote, but has a higher claim on receiving dividends first. On the market cap. The market cap is the price you have to pay to own the entire company through purchasing 100% of its shares. So it's taking the share price of the company and multiplying it by how many shares outstanding there are. Now on to earnings per share, or EPS. EPS is how much each individual shares, and they're usually over hundreds of million shares, earned by itself. So to get that value, we take the net income of the company, which is the amount of money they earn after they pay every bill, and they take the net income and divide it by how many shares outstanding there are. And this shows how much each share has earned by itself. Alright, so the next medium four we got are bear, bull, volatility, and Bluechip. Okay, so a bear market is when the market is going down. It's when most people are selling, which causes more people to sell. This causes a downward spiral of the stock market. It's when you see the Dow Jones is red and the S&P 500 is red. And it usually enters a bear market after a 2-month period, and when the market has moved at least more than 20% down. A bull market is the opposite. A bull market is when the market is mostly buying, and because people are buying, more people are buying. This is when you see the Dow Jones is green, and when you see the S&P 500 is green. We are currently in a bull market. Next we have volatility. And volatility is how much a stock price can move relative to its share price. A volatile $10 stock will have large price movements relative to a share price over a short period of time. These can be price movements of over $3 or $4 with the $10 share price. A non-volatile $10 stock will move very little compared to that share price, maybe at 50 cents a day. The next we have is blue chip company. For example, blue chip companies are Apple, Google, and Amazon. These are companies that are so financially steady that it would be hard for them to go out of business. They have a history of financial strength, as well as usually pay dividends because their earnings are so high and their financial backbone does not require those profits to be reinvested in other than the shareholders. The last three terms are assets, liabilities, and stockholder equity. It's an accounting equation. Assets is equal to liabilities plus stockholder equity. So an asset is a resource that has a value and will have a value in the future. Assets can be factories, inventory, anything that has a value which can be used in the future to reduce cost or sell for cash. The liabilities of a company are an obligation for the company to pay back. Liabilities can be debt, they can be accounts payable, they can be mortgages, and they could also be any expenses that have been accrued. This is what the company owes to be paid in the future, and they're usually long term. Lastly, we have stockholder equity. And a stockholder equity is all the money that has been received in exchange for stock. So when you buy a stock for $10, you're paying the company $10, and that $10 is shown on their stockholder equity section in the balance sheet. And this also includes retained earnings and donated capital. These are very basic stock market terms that I define very simply, and you must know these. So if you liked the video, hit the like button and also subscribe because I post early in the morning when the stock market opens, and that's when my videos have the most value. This Sunday, I'm posting a video on Amazon's Q1 estimates, and I'm going to be analyzing their previous Q4 report.